between 3:15 and 3:45, last hour macro, it will run on liquidity that has not been engaged, meaning here's 3:15 New York local time, 3:45. That's your last hour trading the macro. The algorithm will do a spooling. So you could be a buyer trading down here, a volume imbalance, order block, buying that at the 15-minute after 3 o'clock and expecting price to start delivering higher. And once it creates this scenario, you are entering into a buy program. A buy program is not a market maker buy model. A buy program is when the market goes, when an algorithm starts going into buy side delivery, meaning when the market starts delivering price higher, it matters not how much buying pressure there is or how much selling pressure it is. It's going to go there regardless of whether you want it to or not. Because if the market's going to go there, it's going there. And it can do so with low volume. The market rallies from here and enters a buy program. Buy program is when the market just starts booking higher prices until we get to a pool of liquidity. In this case, it would be buy side here, or a premium inefficiency, which would be an example like this right here, this small little fair value gap. So the difference between this candle's low and this candle's high is a SIBI, sell side imbalance, buy side inefficiency. That's the classification of this particular fair value gap, meaning it only offered sell side. So to be repriced correctly and have an efficient fair value offered to the marketplace between this candle's low and this candle's high, it will want to reprice up to it here like it does with up close candles. The market will deliver it on an up basis. So it's now offered efficiently through the scope of fair value. It is not rebalanced because it did that. That's not rebalancing. It's repricing. When it leaves this range, then it is balanced. Then it's likely to support price where it doesn't need to go back down there. So that's the only distinction I'm going to make here. Now go back to that low. Once it enters the buy program, you know that it's likely to trade up into here. Why? We've already worked lower. I showed you where the smart money shift to bullish, why they're going to be reaching for all this buy side. Once it starts rallying, every down close candle or series of down close candles, if there's ever a series of down close candles, you use that entire block of down close candles as one, because it's delivery that you're looking at, not just simply one candle. One candle does not make a narrative. One candle doesn't make a order block. It's this change in the state of delivery that is the order block. What do I mean by that? 3 down closed candles, that opening price right there, that candle's opening price, you're going to look at this value right here, okay? That price is 4145.75. As soon as that price is traded to and one tick above it, that becomes an order block. This change in the state of delivery right there, once this occurs on that candle, this opening price becomes fair value. That means that the market, when it trades through it here, it's going to want to do what? Offer smart money. And when it comes back down and touches that, they're buying it. When it trades on this candle here and trades and goes down to it again, they're buying it. Their algorithm, which is high frequency, and it's hammering, constantly hammering the market at these price points. They're buying it here, they're buying it here, they're buying it here, and they're buying it here. Every single time we leave a down closed candle, they're watching their positions move into profit. Every time that we see a new change in the state of delivery, it's offering them another opportunity to build their position and build it larger. Remember, the focus is over here. This is the draw on liquidity where the market's going to be pulled to. Why? Why should it go up there? Because there's buy side up there. Buy stops. Willing buyers to buy at a higher price when it's down here. Think about that. That's the life essence of these markets. It's going to where the orders are and inefficiencies. So the market's going to seek liquidity and fair value constantly. It's always this ebb and flow between the two. It's constantly trying to facilitate the most efficient model of delivery for price. That's the function of these price engines. It's doing that. Once it does this and it stops here and pulls away, every trader is going to do the same thing. Once that's done, once that hook is sunk in, it's over. The market goes down. When this pass here occurs, traders are going to look at that and say, oh, it's going to take out that low. They want to be short. Selling, selling, selling. Smart money's buying, buying, buying. Changing the state of delivery. Buy, 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 buy. Boom. Displacement. We're taking out a short-term high right here. Now, think. This becomes the 2022 model. Low, lower low. Sell side's taken. We're inside that time window between 15 minutes after 3 to 45 minutes after 3. So that closing hour, final hour of trading, you're going to see a macro run to the liquidity that has not been engaged. That's this over here. Changing the state of delivery. Buy, 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 buy. Displacement. Shift in market structure bullish. This is where I've been telling you to buy. This is where I buy. This is where I buy. That's where smart money engages. They're in early. I'm teaching you how to get in where it's obvious to see it. Isn't that obvious now? That's exactly what I taught you in the 2022 model. Buy in this fair value gap. Okay. Don't trail the stop loss up real tight. You got to get first profit before you ever roll your stop to anything considered break even or close to that. So are you stopped out here? No. Market rallies, comes back into another fair value gap here, trades into it, rallies. 2 down closed candles. We trade through it here. That becomes an order block. It's a change in the state of delivery. It's delivering now, buy side. The next candle opens here. What is that? It's a volume imbalance. If it opens here, expect it to trade back down. Just to close that gap to that opening price? No. Trade into this candle, that opening price. Trades into it, smart money will buy there. What happens after that? Rallies. It does not rally because smart money bought. It does not rally because smart money has more buying pressure. It rallies because it's rallying. It's designed and it's coded to do so. So you see again another final trading day, final hour of trading macro between 3:15, 3:45. What's actually occurring there? It's a function that will make the most sense for some of you when you think that the market's bullish and we had a big bull day and it runs up, makes a high of the day, and then usually this time of day, the market will pull off the highs and close near the high, but not at the high. But if you're in a time when the market's trying to press out of a consolidation, we're in this range-bound consolidation. So the market's going to start probing outside those boundaries. And by knowing what you're trading in terms of direction, and then you focus on specific times of the day where I'm teaching these macros exist, the 15-minute mark to 45 minutes after 3 o'clock New York local time, that macro is market on close. It means it's going to cause a price run as we get in towards the end of the day. If you do not have a clear setup and it's not obvious, you do nothing. And you just wait for 20 minutes to 15 minutes before 4 o'clock. And then you'll get some kind of a 5 to 8, maybe sometimes 10 handle run.